Cast of the. Oh, I'm sorry. Just let me start again. This is my bad. One second.
Wrong podcast.
Yeah, wrong. I did too many. Stan, countdown in five, four, three, two, one. Hi, everyone, and welcome to Strategic Wealth Strategies Podcast with our host, Alan Porter. Alan, what's going on, man? How are you?
Well, it's a beautiful day here in North Carolina, Neil, and I think I'll be playing golf later on this afternoon, as
E-
usual.
Exactly, Alan. And we have a great guest today, don't we?
Absolutely. I met Derek down in Cancun on a business trip I went to, and very impressed with him and what his company offers.
All right, fantastic. Thanks again for stopping by, Derek. We appreciate it.
No, glad to be here. I'm definitely not going to be playing golf later this afternoon, hence me shaking my head. It snowed where we are up
Oh,
in
man.
Logan, Utah. Yeah, we get that mid-April snow. It's kind of a regular occasion every year.
All
Well,
right.
Derek, who is Strategic Associates, and how do you work along CPAs and advisors?
Sure. We started back in 2010. Strategic Associates is a tax planning firm that we've taken pride in working with CPAs and advisors nationwide. So the majority of our calls every single day, the majority of our appointments every single day are working alongside other tax advisors, tax planners, life insurance advisors, financial advisors that are trying to help their clients ultimately save money in taxes, of course, in a legal and ethical way, and then take those savings and do what they do best with those savings, to kind of help expedite the legacy planning for their clients. But we're ultimately a tax planning firm that just helps clients learn more, vet more, understand more about programs that are available to help them save money, pay less in taxes than they otherwise would if they just continued with the status quo.
And Alan and I talk about education all the time, and most firms, not like yours, don't do that, as Alan's talked about constantly. And that's why he works with a team of professionals, and that's why he's partnering with you. Why do so many high income individuals feel like there's nothing they can do about taxes?
You know, Whenever anybody starts a new job, starts a new business, starts a new practice, starts new, they start fresh. Typically, we're younger and we start where we a lot of times people start doing their own taxes, TurboTax or something like that, and then they graduate into H&R Block, or maybe they hire a CPA down the road. And that CPA typically, and this isn't anything against them, but they've just been doing the same thing that they've always done, right? So they started off making 50, 60, 70, whatever that might look like. But as a graduate into higher incomes, they're still doing the exact same tax planning. And by tax planning, what I mean is they give their financials, their numbers to their CPA or accountant in March or April. And the accounting firm plugs those numbers into the system and spits out either what they owe or what they're going to get as far as maybe a refund is concerned. And um, what they don't know is there are other things that they could have been doing all along as they're growing along with their business and their income, that there are other options that they can be doing that they just didn't know about. There's so many other options out there that they just don't know about. Like you said, it's about education, Neil, educating the client that there are other things that you can do to help mitigate, some taxable income and therefore pay less in taxes, but they just didn't know about it because they're growing, all along with the same tax advice, or I guess just in the end, like I said, they just didn't know about the education and other things that they can do to help lower their taxable income as that grows into higher income. Does that make sense?
Yeah.
I know, Derek, there's so many people out there that have no idea what's going on in their taxes and their investments and everything. I ask a lot of affluent clients, I said, you may have the greatest advisors in the world, but it's what they don't know. It's going to end up costing you hundreds of thousands, not millions of dollars, in undue taxes, fees, and lost opportunity costs. And they said,
Absolutely.
well, I agree with you, but what do you mean by lost opportunity costs? I said, what if I could set a tax strategy up with you through my team, and we pay for your retirement? It's completely tax free that will eliminate or mitigate all the risk in retirement that many of these other financial structures only compound. And I said, when's the last time any of your CPA, your attorney, or your financial advisor ever give you any proactive advice on saving taxes? It's slim to never. And
Other than, the traditional, typical, what everybody does know about, like a 401k, which is
oh
just
yeah, yeah.
another part of the tax code, a 401k, and there's nothing wrong with a 401k, but that's not exactly tax advice. All we're doing is deferring the income that's going to be taxable down the road. In fact, sometimes with our clients, and again, there's nothing wrong with the 401. We're not demonizing a
Well,
401k. Yeah.
here's something I'd like to tell you about that 401k. First off, 58% of the people don't even think there's a fee in their 401k. The average fee in a 401k is 2.99%. People have less than half their money when they go to retire, and
Yeah.
they're hit with taxes anywhere from 20 to 55%. And they'll be out of money anywhere from the fifth to the seventh year.
Would you rather be taxed on the seed or
Yes,
the
that's
harvest?
what I tell them.
Right? Yeah.
Let me ask you this question: at what income level does proactive tax planning actually start to matter?
Yeah, I mean, we can be proactive as far as even just learning and educating, and that's part of what this podcast is. That's why it's beautiful what you guys are doing. Is just if somebody's making $150,000 and they're starting to feel that pinch of paying taxes, right? They graduated from college, they started their job or whatever, and they're paying $5,000 or $6,000. And like, yeah, it's not that big of a deal. Then they get down the road and they're paying $50,000, $60,000 in taxes, and it starts to feel like a much bigger deal. But they're getting the same tax advice that they had already, always received, and that's the definition. What's the definition of insanity?
Doing the same thing over and over, expecting a different result.
And then finally, people get to a pain point where they're like, I can't do this anymore. I'm so sick of doing this. I'm so sick of writing that check at the end of the year, whatever withholdings might be. I'm so sick of paying so much in taxes that they finally decide to do something about it. Now, we can be proactive, and that's what we're doing right here as far as the education portion of this. Being proactive and making decisions is a little bit of a different story. As far as from a financial standpoint, though, where it really makes sense and it really helps people substantially, we want to help everybody. Under $500,000 a year, we can help, but sometimes the juice just isn't worth the squeeze, right? The cost of participating in the leveraged charitable donation, utilizing a 501c3 charity, right? Using a cash donation, sometimes using bonus depreciation by purchasing a tangible asset within an LLC. Sometimes the cost of that tangible asset isn't worth, sometimes it exceeds what they were just otherwise paying taxes.
Right.
What we have found for all of your listeners, anywhere between California, New York, New Jersey, Florida, Texas, coast to coast, Northeast, Southwest, $500,000 or more of taxable income, we can always do something. And when I say always, going back to another question as well, like, why do they feel like there's nothing they can do, right? When that question is asked, why do some taxpayers feel like there's nothing they can do? It's a lot of times it's because they're W-2 high net worth income earners. If they're earning a W-2 income, most of the time they're told there's really nothing you can do, right? Make another donation, something along those lines. But in reality, if they're making $500,000 or more, whether it be W-2, if they're a business owner, if they're receiving commissions, 1099s, or even long-term capital gains, we can absolutely help with $500,000 income or more.
Absolutely.
And that's huge for sure for people because they at least have some hope now. So, what are the biggest mistakes business owners and high earners make?
The biggest mistakes, I would say procrastination. I would absolutely say procrastination. Most of the time. So Q4, we're very busy. We're working from 6 a.m. to midnight pretty much every single day because Q4, people know what their income is going to be. They know what they need to mitigate. They know if I'm going to be paid $1 million this year through my business, I'd rather pay taxes on $300,000 than $1 million, right? But if it's December 15th and there's only so much we can do at that point, and they only have so much left, there's only so much that we can do towards the end of the year. So I would say procrastination. If we can have these conversations early, it's April, May, June, July, August. If we can have these conversations, and the key here is tax planning. If we can plan ahead to avoid paying an exorbitant amount of taxes by mitigating and lessening our taxable income, then they can plan ahead. They can budget. They can lessen, if they're W-2 income earners, they can reduce their withholdings from their W-2, from their paychecks, pay less in taxes, save some money on the side to be able to participate, in the programs. I would say we kind of talked about 401ks. I would say overutilizing maybe some of those programs, those tax deferral programs. I would say that's not always the best tax advice. I think there's a place for everything. I'm not going to tell anybody that shouldn't be the case or otherwise. And I do think relying solely on one advisor. I think sometimes we put all our eggs in one basket. You ever seen that happen, Alan?
All the time. When I talk to people, I say, well, listen, you may have the greatest advisor in the world, but I'm not here to replace any of them. I want to work with you as a team to give you the best possible scenario. And what I mean by a team is I have a team of specialists on my team. And what I mean by specialists, I can be your family doctor. I can treat you for minor illnesses, minor injuries, but you want your knee operated on, you want the orthopedic surgeon, the specialist. Right. And that's what I have in my team. Top tax specific CPAs, attorneys, and other people just exactly like you, Derek. And we collaborate together to come up with solutions for people's financial problems. And it's just like I give those other two questions. When's the last time any of your advisors ever give you any proactive advice on saving taxes? It's slim to never. Well, the people who talk to me, we give proactive advice all the time. And it's not just me, it's my team of people, the experts in the field.
That's right. And you said team multiple times in there. We all work together, and the team works for the client.
Yes.
And we work, again, together for the greater cause of, in this scenario. Imagine how much faster we can expedite the legacy of one of your clients or anybody, a prospect A. They come in and say, look, I'm paying $200,000, $300,000, $400,000 in taxes a year. I'm paying $100,000 in taxes every single year. If we could save $40,000, let's just say hypothetically, I'm using arbitrary numbers for the sake of this conversation, but if we could add, 30, 40% back into their life in tax savings, how much faster can they expedite? And again, working as a team. So how much faster can they expedite? If I can help your client, Alan, if I can help your client save 30, 40% and add that back into their life, can you imagine some buckets of opportunities to help expedite their legacy of either retiring earlier, selling their practice? I think the number one fear that people have, we all know we're going to die.
Yeah.
Pretty inevitable. Death and taxes. Talking about both right now.
Yeah.
Where I'm going with this, though, is that I think more people are afraid of outliving their income after retirement than they are of the inevitable. And
that's number one fear in retirement, outliving your money before you run out. I mean, running out of money before you run out of life. That's the number one fear in retirement.
Exactly. If we can help them do that, we win. We all win. Rising tides lifts all ships. And those are the scenarios that we look for as a team to help those clients cross the finish line with more money in their pocket.
I understand. The one thing I tell people in retirement, it's not about rate of return. It's about distribution of your assets.
Yeah.
And you may have the greatest returns out there, but now you got to pay taxes on it.
Yeah.
And people have no idea about IRMA taxes. Heck, it's
a real thing.
IRMA taxes, it's tens of thousands of dollars per year, and they're not prepared for it.
That they were not accounting for.
No. Let me ask this question. How is tax planning different from tax preparation?
Yeah. Kind of goes back to a little bit of what we were saying that again, I'm so thankful. Let me be very clear. I'm so thankful for CPAs and accountants. My brother is a CPA. I have two brothers that one has their master's and the other their accounting degree, one CPA and the other is a CFO for a company. And my point is I'm thankful for all of them because that's not something that I want to do. I don't want to do tax prep. Tax prep again is taking those numbers. Maybe they meet on a quarterly basis and say, okay, this is where you're at. And this is, here's your numbers and here's your tax bracket. And this is what you're expecting to pay all in all come April 15th of next year. And the tax that is not tax planning. That is tax preparation. They're taking those numbers, plugging them into the system, and spitting out what they owe, or maybe they get a refund. Tax planning really is us being proactive ahead of time, saying, okay, what are you projecting as far as your income is concerned this year? And how old are they? What are their end goals? What do they want to retire with? What do they want to sell their business for? What do they want to sell their house for? What is this merger and acquisition company? If they're helping somebody sell their business, we work with these types of advisors as well. And if they can help their clients save an additional 10 to 20% of what they're selling for, that is tax planning. That is us planning ahead to be proactive on legally and ethically simply paying less. Hold on, time out. I believe in paying taxes. I want to be very clear about something. I have a wife and 5 kids. I live in northern Utah. We drive on those. That's Main Street right there. I mean, it's not a very busy metropolitan area whatsoever that you see behind me here. But I believe in paying taxes. My kids go to public schools. We drive on the same roads. We have our first responders. I believe in paying taxes, just not a penny more than we're obligated to. If I can plan ahead and make key decisions that will reduce my taxable income, let's be very clear. We are not evading tax. We are not evading taxes. We're simply reducing our income that is going to be taxed using a variety of different programs. Again, bonus depreciation. People are familiar with writing off expenses through a business or, maybe purchasing an asset. If they write off their cell phones, if they write off their computers, we have larger assets that are leveraged, so to speak, that give them an amplifier. Same with 501c3 charities that we work with. If a client can plan ahead, tax planning, and instead of budgeting for how much they're going to pay in taxes, budgeting for how much they're going to participate in a program that reduces their tax liability, and they're net ahead thousands, hundreds of thousands, some of our clients even in the millions of dollars, 6 to 7 figures that they pay less in taxes because they're planning ahead. We're having these conversations early. And we don't charge a penny until after we help somebody save money in taxes. So these conversations are all just planning ahead for your clients.
Well, absolutely. I mean, one of my clients saved $896,000 last year in a charitable leveraged charitable donation.
You bet.
Then I had another client, a doctor. He procrastinated, and his advisors weren't getting back with him. They said, "Oh, this is not true." And we came back, all the tax laws, everything. They had no idea what they were doing. You got to talk to the experts.
Yeah. Yeah. And that goes back to a prior question as well. I think we addressed well enough but what's the biggest mistake that people make? And it is going in April 15th and trying to do something retroactively. Tax planning is looking ahead.
Okay.
That's key. Looking ahead, and people don't want to plan. Bottom line, at the end of the day.
That's a good point, but they don't want to plan because they're afraid of it's going to be painful, too much work. This is going to be complicated. This is going to be nobody. People dread just filing their taxes. Think if they have to turn their entire estate inside out, and they also don't really want to show all of their personal information. We don't do any of that. We have found over the last 16 years that if we create multiple options, almost a la carte, that people can participate in, just these programs without going through their purse, right? All of their personal financials. And of course we hone in on what is their AGI, what is their expected, tax liability that's going to be based on everything associated. But if we just make it very simple and non-complicated, that they're not afraid of looking into these tax planning options because they can choose A, B, C, or D, or a combination of any of those. And that's going to reduce their tax liability again by a certain percentage, more than enough to justify the cost of everything. Then inevitably, guys, I get the question. And there's 27 of us here. I say I, but I speak collectively for the firm. We get the question after we're done with the call all of the time. Where were you last year?
Yep.
And they just didn't know. They just had no idea these things existed because nobody brought it to them except the good advisors. Listen, the good advisors are the ones that are over the last couple hundred years, there have been plenty of assets on, financial advisors, life insurance advisors, and they're great. They have their place. But it's only been the last decade or so, if not less, where the good advisors are the ones that are first trying to help save their clients money in taxes or anywhere that they're bleeding. What's the greatest erosion of wealth?
Taxes.
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 A large percentage, and how fun, the more you make, the higher you're going to be taxed. And I get it. That's not a political statement, like we're not even going to talk about that, but I get it. But the good advisors are first trying to help their clients save money. Then they're going to say, hey, we saved you $100,000 that was already allocated for it. They already had their hands in your pocket. And a large percentage of that, of your income, was already called for. Well, we just saved you $100,000. How would you like to expedite your legacy? They're taking those savings, the saved money that was already gone, already written off, and putting that money into their legacy, into their financial vehicles, the different buckets that's best for your client. And that's not my job. That's yours, right? That's why it takes a team. I don't want to tell you where to put your money. I want to tell you how to save money in taxes. That's what I'm good at. That's what I do best. And then you guys take that money and put it to work, expedite that legacy, and their financial future, their freedom, and the security, the sense of security that they get from that. Because we all want to make as much as we can, but we're terrified of losing it. Let's help them keep as much as they can of what they make indefinitely. And that planning doesn't just stay in this generation. Alan, does it just stay in this generation?
Well, because I just did one tax strategy last year. This particular guy is getting back $2,280,000 in taxes he's paid over the last 3 years. Now, what we did with that also, we got $1.4 million in qualified plans and paid all the taxes on it. Now, it's not just for his beneficiary; it's legacy planning that will be tens of millions of dollars of tax-free money for his family, and properly managed, it will be generational income.
How much better off as a country would we be if we left behind generational income?
Absolutely great.
And
Better
that's
than we are
leverage.
now.
Yeah, better than we are now.
Okay. So what categories of strategies exist to reduce taxes, not just defer?
Okay, good. Yeah, because some deferral programs are great. The problem is we're kicking the can down the road, and eventually, not always, there are ways around of that, that call being made or that coming due as far as the tax liability is concerned, stepped up basis laws. But the different categories that are very simple to understand and that candidly the majority of our clients that we work with year after year after year come back. They just keep coming back to do are, of course, let's start first and foremost with what most people are familiar with, and that's charitable donations. We've all given money. And I'm a very firm believer of giver's gain. I really am. I believe that we get what we give. So I personally love this category of programs. But typically what people are used to because of their education, because of how they've been brought up, and this is a fantastic thing. I genuinely love philanthropic people. If you give $1, you're going to get $1 deduction from your tax liability, right? From your income, your taxable income, and therefore you pay less in taxes. So if somebody donates, let's say, whether it's to any 501c3 charity, be it their faith, a hospital organization, whatever that might look like. I personally have a few that I love donating to. And when I donate to those year after year, I get a 1-to-1 deduction, a 1-to-1 ratio for a deduction. If I give $10,000, I reduce my taxable income, my AGI, by $10,000. Okay. Well, we do have some programs where let's just use those same numbers for easy math, where if you give or participate with a cash contribution of $10,000, you actually receive a deduction of anywhere between $50,000 and $60,000. So it's a 1-to-5 or a 1-to-6 ratio for a deduction. Now, commonly we see something more along the lines of if they contribute $100,000, they receive a $600,000 deduction. Now, if they receive a $600,000 deduction, we're talking about, I can even just run a pro forma and give kind of a quick idea. Let's just say somebody's making, $1 million of W-2 income. You've got a high net worth doctor. I don't know if I'm able to share my screen. Am I?
I can give you the ability to share. So go ahead.
If you'd like me to, I'd be happy
Yeah,
to.
do it. Go do it.
Okay. What would be a good state? What state would you guys like to see something in?
Let's try Ohio. Is that good,
Let's
Alan?
try Ohio.
Yeah, that's fine.
Just sent you a request to share my screen.
Yeah, you're ready to go.
Okay. There we go. Okay. So here's my screen. I guess real quick, a little more about me. There's my big head and with hair at this time, wife and 5 kids. Just love that little family.
Can you make that a little bit bigger?
Yeah, you bet. Can you not see that very well?
No.
Yeah, we might have to impose this afterwards, but I can ultimately this just gives the math. Let's say you have
Yeah, that's better now.
client in Ohio, okay? And let's say they're making $1 million, and if they did nothing, if they just stuck with status quo, in the end they're going to pay around $318,000 in taxes. Okay, as far as the tax brackets are concerned here in this scenario. Well, if we participate in a leveraged charitable donation program, and if the client contributed $108,000, we won't go in get into the details right now, but the total deduction on a contribution of $108,000 is going to be approximately $577,000. Guys, what that means is that we're no longer going to be taxed on 1 million. Now we're just after this charitable contribution, as it pertains to this program, now we're going to be taxed on $413,000. So inevitably, we're just going to be paying taxes on a lesser amount. In which case, we go from paying $319,000 in taxes to $111,000. That's the total taxes. And this is in Ohio. If I show you California, it's very different.
Yeah, I'm
California,
sure.
New York, it's a different story. Minnesota. So that is a savings of $206,000 right off the bat. We saved your client $200,000 in taxes that otherwise just would have gone to the federal government. But which, again, I believe in paying taxes, but in my opinion, this is only my opinion. You don't have to share it. I think that's too much. Okay. But of course, we had to contribute $108,000 to receive that savings of $206,000, $207,000. So if we net that out, if we subtract the cost from the savings, then our net cash flow increase is $99,000. We basically just saved your client $100,000. They're net ahead. They did have to buy in, so to speak. They had to contribute $100,000, but they ended up saving net around $100,000. That is 10% of your client's income that you just brought back into their lives. And then should we go buy a new car or a fancier boat? I mean, my opinion, no. My opinion is no. But it does free up some capital to live. Like, this is the one shot that we have at this thing called life. Let's make the best of it. Let's make the most of what we have at our fingertips to live our best life, but also leave enough for our legacy, for our heirs, for future planning, to retire early, go on that vacation. We just brought $100,000 back into your client's life that they were missing. I'm sure there's some things, Alan and other advisors that may or may not be watching. Is there something you could do with that $100,000, Mr. and Mrs. Client? Get creative.
One of the things that people talk to me about tax planning, I said, how would you like to recoup taxes that you paid over the last 2 to 3 years? well, how do you do that? I said, well, it's not how I do it. It's who I know that knows how to do it.
Sure.
When I talked to them about this, they said, "Oh my God, I paid millions of dollars in taxes or hundreds of thousands of dollars." I said, "Well, we can possibly get that back for you." I
Yeah.
mean, it's how much is it going to cost? Well, there's a cost for everything. But the cost of not doing something compared to the cost of doing something is far greater. But how do you balance saving taxes today versus creating future tax problems?
Well, it really does depend on, and that actually also still, Neil, it's kind of a hybrid with your question there of the different categories. Okay. So let's continue touching on both of those
Okay.
because that is very relevant, Alan, and that's something that we constantly on every call, every Zoom call, that's typically how our appointments are, but that we're consciously and consistently trying to decide what's going to be best for today, right? And an opportunity cost for the future. And let's balance those. And ultimately it falls on your client. It's what is their goal? I'm here to let them know their options, but what is their goal? And that's different for everybody. And thank goodness that it is, But Neil, it also goes back to the categories. So we talked about the 501c3 charities, that leveraged charitable donation program. But of course, we have other programs where you can actually purchase a tangible asset that reduces your taxable income using bonus depreciation or Section 179. It's just a deduction, and therefore it reduces their taxable income. The big beautiful bill brought back bonus depreciation indefinitely, unless of course it changes within future administrations, which we'll continue to navigate as we go, right? But as far as balancing between, today's taxable income and the future's taxable income and just deferring that income and therefore taxes paid on that income, we have another program that actually is a very efficacious program it is a deferral of income. So it's not always bad. It's not always a bad thing because the opportunity cost. Okay, if I could save a little bit more in year, defer the income that I'm going to pay taxes on down the road, similar to a 401k. It is not a 401k. It is a very different program that we have, and it's not a 1031 exchange. It's an alternative to a 1031. If you have clients or anybody listening, if you've put money into real estate, and I'm sorry if I'm getting off on the tangent here, but if you've put money into real estate and you sell that real estate and you have a certain amount of time that if you roll it back into another property and meet all the qualifications, then you're just simply deferring the income that you've earned, that you've appreciated in that real estate, and you're just deferring paying taxes on that income down the road. We have another program that works very well doing that, and that's typically for someone who just sold their business, just sold their practice. We work with dentists, orthodontists, doctors, entrepreneurs in every industry. And what they don't realize is how much they're going to pay taxes on that amount of income that they just received in that transaction. We have a program where we can actually defer a minimum of 16 years that earned income. And if we take the savings, and mind you, it is a substantial amount of savings, to where if that client takes those savings and invests them, whether it be a life insurance policy, an annuity, the flex, whatever program that looks like in the different bucks for that client, and they earn interest. And then if they pay taxes in 16 years from now, they pay those taxes using the interest they've earned off of tax money they saved.
Right.
Did that make sense?
Yeah.
Absolutely.
I've been hearing it from Alan a lot and different experts that I already know, but this is great. The knowledge you have as a CPA firm, because most CPAs, Alan, don't know this stuff.
No, they have no idea.
No idea. And they don't understand how you're going to attract the best clients possible with these ideas. And that's the key, Alan, right? No doubt.
Absolutely.
100%. So I think it's unbelievable because it's great stuff, Derek, because it really makes it so you've multiple strategies. You're going to be paying less taxes. You're going to be saving for your retirement. You're going to be building up. Your employees are going to see this as a great benefit as well. Everyone wins, and you have cash flow to put back into the business. because biggest challenge business owners face each and every day is cash flow. Cash
Yeah.
flow to spend more money on marketing, cash flow to hire more employees, cash flow to work on AI automations. All these things are bottlenecks for people to grow as a business. The bigger you
Yeah.
grow as a business, the biggest challenge ends up being I don't have enough money to grow more.
Yeah. And typically they cut in some of the areas, and we've all been there. We cut in some of the areas that we need the most, but we feel like that's, you know, expensible, or, if you will. When in reality, if we can do addition by subtraction, if we can add to their income by subtracting from the amount of taxes that they pay, legally, ethically, defensible. So just know, guys, and Alan, back to your question a little bit, just as far as so we balance it out depending on your client's goals. I won't go too far into that because we have programs that reduce their taxable income. It's a one and done, and there's no deferral of income whatsoever. And we have other programs that do defer their income depending on their goals, depending if it's long-term capital gains. Did they sell real estate? Did they sell their business? What does this look like? And then we as a team come together and we propose this package, if you will, for the client, for them to choose. But they have the info. Listen, if they do it, great. If they don't, I understand. We all have our own choices and our own thoughts, the way we look at things. And if that's not part of their plan, that's fine. But at least they know. At least they're educated on their options. And I started to go somewhere else as well, but I forgot.
That's okay.
Yeah.
Let's jump to the next question.
Sure, you bet.
All right. What does a typical client engagement look like for you?
Um, if you can't tell, I love what I do.
I can tell.
But I'm glad. I am glad. But it's not just about the tax planning. I just love people. Like I genuinely love people. I love working with people. When I met Alan, I felt the same for him. He's defended our country. He's a very personable, both, this is fun for me. And this is actually a very similar client engagement that we have on our Zoom calls. It's very similar to what we're doing right now. Alan or any advisor, they bring the prospect to us and they say, look, I know a firm, and they help people, businesses, et cetera, save money in taxes. And they just schedule an appointment and there's zero obligation. They don't pay anything for this call. And we meet face to face, just like we are right now. And we go over the client situation. We go over the prospect circumstances, today, yesterday. So let's do that. And in fact, that might have been where I was going to go as far as retroactively for clients from prior years. I think that's what I forgot to kind of address, but we'll skip that for now. But yes, we want to look at what's their past, what's today, and what are their future pain points and their goals. What's their legacy planning look like? We go through that. We go through some of the financials at a high level just to get an idea if this is going to be an ideal situation for them. And I love talking to those people. I love our people. I really do. We're all we've got, and if we can help each other, I've already said it before. It's cliche. I agree, but I truly believe rising tides lifts all ships. I don't want to cross the finish line alone. I want to cross with everybody
Right.
else. I want to celebrate with everybody else. That's the party. So we meet, we go over the programs, or at least one or two, or a combination of a couple that might work best for them. And then I send them an email and we CC the whole team in so that we're all on the same page. And that can be with the CPA and their CPA or their advisors. We prefer it. Let's all be on the same page. Let's help you win together. And then they go through the information and they can call us, they can schedule other appointments down the road. And it's really, as long as one of the programs, they pull the trigger, so to speak, on one of the programs in year, typically by the middle of December. Now, we do have two programs this year that will take up until the end of December. I'm talking December 30th, sometimes December 31st, we can still take action. But by then,
yeah,
that's tough.
Yeah.
Then they're going to receive that tax deduction in year. And to finish the answer to that question, it's not just what I do. It's not just what Roger, Caden, any one of us advisors do. We're on the front end, but it's on the back end. The service, of knowing that you have a phone number to call, an email to reach out to, someone that you've got an advocate for you. And we have, a staff of 27 to help make sure we do see you through that finish line, cross that finish line. In fact, most of the work, guys, is on us. Sorry, I talked too much and too long about answering a simple question. Most of the work is on us. That's what the clients want to know. I think one of the biggest things, in fact, going back to a prior question or conversation, one of the hardest things they come into this thinking, yeah, that's fine, but I'm already so stressed. I'm already spread thin. I got so much going on. I don't want to add to my plate. No, I don't want you to either. That's my job. That's our job. So the staff, we make sure that we take care of everything on behalf of the client and they receive that tax deduction in year.
Okay.
All right, Derek, I got one last question for you because we need to wrap this up. What's the long-term impact of taking control of a tax strategy?
What's the long-term impact of taking control with these tax programs?
Correct.
The implications, the weight doesn't steer the ship.
No.
What I mean by that is if we're waiting until April 15th to try to save money in taxes for the prior year, most of the time it's too late. And if it's not too late, it's more expensive than if you would have just done it in year. Right? The most efficacious time to do tax planning is now. Is in year. It's in advance. And so the implications truly are my job's the easy part. My job is to help implement these programs, help clients understand what they are, how they work, and how they benefit them, and take those savings. And the implications are up to you and your team.
Yeah.
Those implications are take those savings, put those to work. We really, if it were mine to ever suggest, it's take that money that otherwise was already allocated for, that was already going to Uncle Sam, and put that money to work.
Yep, absolutely.
Okay. Well, this has been a pleasure, Derek. And people will be able to reach out to you by going and contacting Alan, because I'm sure that you guys are partnering together. Anyone that's listened to this podcast or watch this podcast or listen to the Neil Haley show that plays the Strategic Wealth Strategies podcast, they can easily call Alan at 910-551-1046 or email him at strategicwealth, the number 0 @gmail.com, or go to strategicwealthstrategies.com. I really appreciate it, Derek. Great stuff today. I look forward to be working with you again in the near future, and I appreciate you coming by.
Likewise. Thanks, gentlemen.
All right. That was the Strategic Wealth Strategies podcast, guys. Take care.